All right, everybody, welcome back. Today we're going deep on derivatives.
Ooh, derivatives.
Yeah, they're pretty complex stuff, but I think everyone's at least heard that phrase about them.
Oh, you mean financial weapons of mass destruction?
That's the one from Warren Buffett, of course.
Yeah, strong words for sure. But that makes them all the more interesting to learn about, don't you think?
Absolutely. But before we get to the, mass destruction part,
Right.
maybe we should define what a derivative even is.
Yeah, good point. A lot of people find derivatives confusing.
For sure.
Basically, a derivative is it's a contract. Its value is based on something else.
Okay.
Like think about it like a side bet on the performance of something.
Okay.
That something could be almost anything. Stocks, oil, even something like the price of houses.
So that means, like, if I think Apple stock is going to go up, I could buy a derivative that pays me more if that happens.
Yeah, that's the right idea. Let's say you think Apple stock is going to hit like $200 a share in the next 3 months. Instead of buying the stock directly, you could enter into a derivative contract that gives you the right to buy those shares at, say, $180.
So that means even if Apple hits like $250, I could still buy it at $180.
Exactly.
Wow.
That's just one type of derivative, though. That one's called a call option.
Okay.
There's also put options, where you're betting that the price is going to go down, and then futures contracts, which are agreements to buy or sell at a specific price on a specific date.
Okay, so there's like different types, different flavors of these things, but why would anyone even bother with them? I mean, why not just buy the stock or the oil directly?
Well, that's where things get kind of interesting. So derivatives were actually initially created for risk management.
Oh, okay.
Like, think about a farmer. They might want to lock in the price of their crops, before they even harvest them.
Oh, that makes sense.
But over time, derivatives have evolved. They become these tools for all sorts of things, from hedging to speculation.
Hedging, isn't that what airlines do with fuel prices?
You got it. Like, let's say an airline is worried about fuel prices rising, right?
Yeah.
They could use a derivative, specifically a futures contract, to lock in a price for fuel months in advance.
Yeah.
That way, if the price goes up, they're protected.
But if it goes down, they're kind of stuck paying that higher price.
Yeah, they might miss out on potential savings, but at least they've eliminated the uncertainty.
Makes sense. Okay, but what about speculation? What does that mean?
Well, speculation is using derivatives, basically, to bet on the direction of an asset's price.
Okay.
For instance, let's say you think that the price of gold is going to totally plummet, right?
Okay.
You might buy a put option that gives you the right to sell it at a certain price, even if the market price is much lower.
So if I'm right and gold prices tank, then I make a bunch of money.
You could, yeah, potentially.
Yeah.
But speculation, it comes with a big if, right?
Sure.
And this is kind of where we start to see why Buffett called derivatives weapons of mass destruction. Because with speculation, you're not just managing risk. You're actively taking it on,
Oh, okay.
often with a lot of leverage.
Okay, wait. Leverage? What's that?
Well, leverage is essentially using borrowed money to amplify your potential gains.
Okay.
And losses, of course.
Yeah.
Imagine you just put down a small deposit to control a much larger position in the market. It's like betting on a horse race, but with borrowed money. You could win big, but if you lose, you're in big trouble.
Okay. Yeah, that does sound pretty risky.
Yeah.
So are derivatives inherently bad then? Or is it just how they're used?
They're kind of both, right? They're tools.
Yeah.
And like any tool, they can be used for good or for ill.
Right.
And believe it or not, even Warren Buffett has used derivatives strategically in his investments.
Oh, really?
Oh, yeah, but always cautiously. In fact, there's this great story where he said...
Oh, I remember that one. He said something like, I have 200. I know every single derivative we own.
Yeah.
You don't know anything about derivatives. Good news, I'll tell you. Sit back, relax, grab some popcorn, and listen.
Yeah, that's the one. I think Buffett was making a point about understanding what you're getting into with derivatives.
Right.
He's not necessarily against them entirely, but he's definitely wary of, the misuse and the excessive risk-taking that can happen.
It seems like the more we dig into this, the more complex it gets.
Yeah.
So is it even possible for the average person to, wrap their head around derivatives?
It definitely takes some effort, but it's not impossible.
Okay.
And I think it's important for people to understand at least the basics, because whether we realize it or not, derivatives have a huge impact on our lives.
You're right. The video mentioned that the derivatives market is absolutely massive, like bigger than the global GDP.
It is.
Yeah.
And that size, coupled with the complexity, is part of what makes them so potentially dangerous.
Okay.
Think about it. If a small group of people are making huge leverage bets, bets that nobody else understands. What happens when those bets go wrong?
Uh-oh. Now you're making me nervous. So is this where that whole weapons of mass destruction thing comes in?
It's definitely part of the equation. But before we get too deep into the potential downsides,
Okay.
let's talk a bit more about the different types of derivative and how they're used in the real world. We'll come back to Buffett's concerns and the whole systemic risk thing later on.
Okay, yeah, let's do that. Let's do a deeper dive into these different types of derivatives.
All right, so let's unpack these different types of derivatives a little more. Remember that bike example from the video?
Yeah, the one where my friend's moving to Hyrule.
Exactly. That was a simplified way to illustrate a forward contract. Like you and your friend made a deal to buy and sell the bike at a set price on a specific date in the future. But forward contracts can be customized for all sorts of things, not just bikes.
Oh, okay. So it's like a tailor-made agreement between two parties.
Exactly. Now, imagine if you took that bike agreement and you standardized it, like preset terms that are traded on an exchange. That's basically what a futures contract is. They're used for a wide range of assets, from commodities like oil and gold to financial instruments like stocks and bonds.
So it's like going from a bespoke suit to buying something off the rack.
That's a great analogy. Futures contracts, they bring this liquidity and this standardization to the derivatives market. Now let's talk about options. Remember how you could buy a call option on Apple stock?
Yeah, it was like a rain check to buy those shares, even if the price went up.
Exactly. So options are a little more complex than futures contracts because they give you the right, but not the obligation, to buy or sell the underlying asset.
Okay.
It's like having a reservation at a fancy restaurant.
Yeah.
You can choose to show up and enjoy your meal, or you can skip it if something else comes up.
So the call option, I'm betting that the price will go up. And then with a put option, I'm betting that it'll go down.
You got it. And this is where things can get, well, really interesting and potentially risky.
Yeah.
Because of leverage. Remember how we talked about leverage, amplifying gains and losses?
Yeah. Yeah. That was the part that made me kind of nervous, like betting on a horse race with borrowed money.
Well, imagine that horse race is the stock market. And you're not just betting on one horse, but on the entire race. With derivatives, especially options, you can use leverage to control a massive position with a relatively small amount of capital.
So let's say I'm like super bullish on electric vehicles and I think Tesla stock is going to go way up.
Oh.
I could use leverage to amplify my potential gains.
Exactly. You could buy call options on Tesla. And with leverage, you might only need to put down a small percentage of the total value of those contracts. So if Tesla stock skyrockets, you can make a huge profit.
But if it goes down,
You could lose more than your initial investment, yeah.
oof. Okay. So that's why Buffett's so wary of these things, especially when they're used for speculation.
Right. It's that potential for huge losses multiplied by leverage that can create systemic risk.
Systemic risk, that sounds pretty serious. Is that what Buffett was getting at with that weapons of mass destruction quote?
He was definitely alluding to it. Systemic risk is the idea that a problem in one part of the financial system can trigger this chain reaction and lead to a wider crisis.
Oh, okay. So it's like dominoes falling. One derivative bet goes bad, and it triggers all these losses across the market.
That's the general idea. And when you have a market as big and as interconnected as the derivatives market, the potential for systemic risk is pretty significant. Remember, we're talking about a market that's bigger than the global GDP.
Wow. Okay, that is scary. So how do we prevent these financial weapons of mass destruction from actually going off?
Well, there are a few things that can be done. First, we need more transparency in the derivatives market.
Okay.
Right now, a lot of these transactions happen over the counter, meaning they're not traded on public exchanges.
So they're kind of like hidden.
Yeah,
Yeah.
exactly. And this lack of transparency makes it hard to, assess the overall risk in the system.
So more sunlight on these transactions could help?
Absolutely. Second, we need stronger regulation. After the 2008 financial crisis, which was partly fueled by derivatives, there were some efforts to increase regulation.
Right.
But many people argue that more needs to be done.
Like what kind of regulations are we talking about?
Well, things like requiring more collateral for derivative trades or limiting the amount of leverage that can be used. And, imposing stricter capital requirements on institutions that deal in derivatives.
So stricter rules of the road for the derivatives market.
Exactly.
That makes sense. But even with more transparency and regulation, doesn't it still come down to individual responsibility? I mean, people need to understand what they're getting into with these instruments, right?
You're absolutely right. Education and awareness are crucial. Investors need to do their homework, understand the risks, and make sure they're not, taking on more risk than they can handle.
So before you even think about dipping your toes into the derivatives pool, you need to be a strong swimmer, so to speak.
Exactly. And even experienced swimmers can get caught in a rip current. Derivatives can be powerful tools, but they're not for everyone.
For sure. Okay, so we've covered the different types of derivatives, the potential risks, and the importance of transparency and regulation. What about Buffett? Didn't he also have some specific concerns about the complexity of these instruments? I remember reading something about him saying he called them hell for the uninitiated, didn't he?
He did, yeah. And I think that quote really speaks to just how complex these instruments can be.
Okay.
Buffett's concern is that a lot of people, even seasoned investors sometimes, don't fully grasp the intricacies of derivatives
Yeah.
and the potential risks.
So it's not just about like individual investors making bad bets. It's about a lot of people misunderstanding and miscalculating, which could affect the entire system.
Exactly. And when you think about how big the derivatives market is and
Yeah.
the leverage involved,
Right.
those miscalculations,
Yeah.
they could be catastrophic. I mean, that's why Buffett's been so vocal about, transparency and regulation.
It's interesting, right? Because on the one hand, you have these super complex financial instruments most people don't understand.
Right.
But then on the other hand, they're having this huge impact on the global economy, whether we realize it or not.
It really is a paradox.
Yeah.
Derivatives are often seen as this niche area of finance, but their influence, it goes way beyond Wall Street.
For sure.
I mean, think about it. They're used to manage risk and to speculate on all sorts of things: interest rates, currencies, commodities like oil and agricultural products,
Yeah.
and those price fluctuations.
Yeah.
They end up affecting all of us, consumers and businesses alike.
So what can the average person even do about any of this? Like, I'm no financial expert, and I definitely don't plan on trading derivatives anytime soon. Should I even care?
Oh, absolutely, you should care. Even if you're not directly involved in the market, it's important to at least be aware of it,
Yeah.
aware of its existence and its potential impact. Informed citizens can advocate for policies that, promote transparency and responsible regulation.
So knowledge is power.
Exactly.
The more we understand about these systems, the better decisions we can make.
I couldn't agree more. And, beyond just understanding how derivatives work, it's also important to think about their role in the economy.
Okay.
Are they mostly tools for risk management, like they were originally intended? Or have they become mainly instruments of speculation, driving volatility and instability?
That's a big question. I don't think there's an easy answer to that.
Yeah, you're right. It's a very complex issue, but it's a conversation worth having. As we move forward, we need to really think critically about how these things are being used, who benefits, what risks they pose
Right.
to the whole financial system.
So derivatives are powerful tools, but they're not without their dangers. We need to understand them, question them, and demand transparency and accountability from those who use them.
Well said. As we wrap up this deep dive, I want to leave our listeners with one last thought.
Yeah.
The world of finance is constantly changing, and derivatives are probably going to play an even bigger role going forward. So stay curious, keep learning, and stay engaged in this conversation about how these instruments are shaping our world.
Awesome advice. Thanks for joining us today for this deep dive into the world of derivatives. Until next time, keep exploring, keep learning, and keep asking questions.